Now, all this leads us to ask the question, should we get ready for a Q4 rally? Should we be ready for a Q4 rally? I'm of the opinion that the answer is yes. We have been saying now, and I think I mentioned to you on the last Robinson Report video, which I hope you're getting those. In addition to the Robinson Report, we put out the PDF every weekend. We also have a complimentary video or a video that goes along with it. And I hope you're checking that out or you're getting a chance to look at that. And I see many of you are, from the analytics. But the point is that the Q4 rally we think is going to be bigger than many people expect. And I'm not saying we're going to get, shoot to the moon here in Q4, but I think there's been so much fear, there's been so much confusion over the last few months. But when you look at the data and you actually look at the history of how these things tend to play out historically, you tend to see pretty hefty rallies in Q4, especially after you've had perhaps a weaker Q3. So if you have a big Q1, big Q2, and then you have a weak Q3, which is actually pretty common because that's the September quarter, where you have September, which we talked about the September effect. My friend Jeffrey Hirsch, who runs the Stock Traders Almanac, who will, by the way, also be speaking at the Money Show today along with me, has called October the bear killer. It's the month of the year that's the bear killer. So typically you'll see a bear market crushed in October. You tend to see capitulation there and then a rebound. Maybe we're there. Maybe that's what we've seen over the last little bit, because we've certainly seen the dollar reach that area of resistance that we've been talking about, 106 to 108, and now it's beginning to try to fade from there. We've also seen bond yields surge, kind of like have this, really sharp rally, and then it seems to be kind of fading now. We're going to watch that and see. Of course, those things could continue, but it's also possible that we've seen the height of it, and that we're going to now see a little bit of a mellowing out of those rallies in the dollar and in bond yields. If that's the case, then that sets us up for a Q4 rally that could be pretty impressive. Q4 is the strongest quarter of the year in the S&P 500. Going back to 1950, you'll see that out of all four quarters, the average return in the fourth quarter is big. It just tends to be bigger than all of the others. So that's important. This data here from Zacks showing that when performance of the S&P 500 is 10 to 20% year to date through September, okay, just like we are now, there's only been, going back to 1950, there's maybe been like 20 years or so where you had the S&P up 10 to 20% year to date through the month of September. So as you head into October, November, December, this final quarter, how do things tend to turn out, in Q4? Well, you'll notice that almost every time that we've had, a return like we have had here, like in 2023, we had about a 13% return year to date through the first three quarters. Okay. So what are we going to have this year as far as returns? Well, historically, we've had 1, 2, 3 years where we didn't get a rally, where we didn't get a pretty good gain. And you could also probably throw in some of these smaller numbers and say, well, we probably want to discount these too. These aren't really big. These are pretty tiny. But barring these, for the most part, you see many of the numbers are pretty big. So, but the point is that we expect that Q4 is going to be a little bit of a shaking off of the bearish sentiment as people now come to realize that the Fed is not going to continue lifting rates, for an infinity time period, right? And the stock market tends to be looking forward about 6 months ahead, and they've been waiting for the Fed to be like, yes, we're sort of done with this. The Fed has not given them that. The Fed continues to dangle this carrot on a stick, jawboning, saying we think we might hike rates later this month or later this year, or maybe and they've also been talking about what they might do next year. Okay, well, remember, the Fed says a lot. They say a whole lot, and we've been monitoring the Fed and talking about the Fed. I wrote a book about the Fed, all that. So we've talked about the Fed. But the Fed just talks, you got to watch what it does. And the market will soon catch on that the Fed is not raising rates anymore. It's just talking about raising rates, and it's not really raising rates. And then they're going to, and then at some point, the Fed's just going to say, okay, we've reached the terminal rate. We've reached the top rate. They really haven't said that. The ECB has said that. But then you haven't had that here in the United States. So the Fed will eventually pivot to a stance to where it says, okay, we're done with the rate hikes for now. And that they haven't said that. They've just been on pause saying we might do one more. So there's going to be a shift in that moment. When they do announce that they're going to, probably not be hiking rates again in the near term, that could lead to a near-term sell-off. It may not lead to an immediate rally, but that sell-off will then very likely be followed by a rally. So, because some people might be disappointed that the Fed's not going to raise rates anymore, if that turns out to be what they're going to do. So Q4, we believe, is going to be a pretty good quarter, certainly better than Q3. And we suspect that you're going to see some of the usual suspects doing well. Communications, which we own in the sector portfolio, the tech sector, energy to an extent. As I had told you a while back, one more thing on energy is that we had told you a couple of weeks ago that we thought the easy money had been made in energy because it had this nice, rally from its June lows or whatever. So we're of the opinion that, energy could have a little bit more upside. It could rally a little bit more. But we're of the opinion that we're not going to just see the previous, highs we saw last year or anything like that, barring some sort of increase in the intensity of the present war in Ukraine or the war now that we have in Israel. Those things can spread. Obviously they can spread. That's one of the concerns you have about Ukraine. People have often mentioned this is not a good area to be having a war. Historically, this is a negative area. This Eastern Europe area is a dangerous thing. Well, we can say the same thing about Israel. When you start having wars in Israel, it's not a good thing. And you and I haven't lived, well, some of us have seen, remember, I wasn't around the 1973 war, but some of you were. You remember the 1973 war. That's the last time Israel declared war. So most of us who are sitting here right now, we haven't traded through or invested or been alive or thought about money, and preserving our assets in the middle of an Israeli war. We've had skirmishes. We've had things that have popped up. We've had, all kinds of, but never a declaration of war the way we've seen now. So this is a little different. And it could cause the world to take sides, and then you could have a problem here. So the concern is that we want to see these wars come to an end. We want to see peace. We want to see this stuff stop. Enough of the violence. It's not going to fix anything.